Hello, and welcome to the Performance Leadership Learning Lab's virtual roundtable titled The End of Too Small to Sell, Rethinking Exit Value in the Microcap Market. We're glad you're here. Before we jump in, a couple of quick notes. A replay of today's session will be available for all registrants tomorrow. You'll receive an email with a link to our PL3 YouTube channel where you can access the session and other past roundtables. If you have questions that come up today during our panel session, feel free to drop them in the chat. We'll save time at the end for audience Q&A. I'd like to have each panelist begin by introducing themselves and sharing a bit about their role and background. Will Lindstrom will kick off with you, and then Andrea, Bob, and Angela.
Yeah, hi everybody. My name is Will Lindstrom, and I am one of the co-founders of the Culture Think Tank and the PL3, which is the Performance Leadership Learning Lab. And largely what we've been focused on is how do we rethink the microcap market by providing the technologies that allow small companies to achieve scale through technology and some new innovations. And that's why I'm excited about this whole concept, because there's a lot of really cool small little companies that have great margins, are great prospects, and just really have a scale issue.
Yeah. Andrea?
Yeah, happily. I'm Andrea Martin, and I run operations at The Crucible, which is a leadership assessment focused for the investor-backed space. So excited to be here and join this conversation.
Bob, go
Hey
ahead.
there, I'm Bob Dunn, Chief Product Officer with the Association for Corporate Growth and Managing Director with GF Data and a partner in the PL3. GF Data is what we believe the best data source for middle market valuations and other financial information out there for the middle market. We have a cadre of more than 300 private equity firms that contribute their deal data to us on a quarterly basis. We anonymize and aggregate it and provide benchmarks for how the middle market is faring. So excited to be here, excited to talk about some of the smaller companies within the middle market, and excited to be in the conversation.
Angela.
Yeah, hi. My name is Angela Rose. I'm a business advisor, and I've been on the buy side of M&A for several years, almost 10 years now. I've actually been working with several of small business owners, and so today's conversation is very near and dear to my heart. Now I'm working more on sell side advocacy, and yeah, so we're excited to be here, excited for the conversation.
Excellent. Well, thank you for all the introductions. I'd like to begin with a broader framing question for the group, especially around the challenge of too small to sell. For years, founders have been told that their companies are too small to sell. From your perspective, is this really about company quality or the market structure? So, Will, we could kind of kick off with you, because historically, sell side has been attempted before. What assumptions or biases cause this problem?
Yeah, so part of what I've been looking at for a while is understanding why these small companies can't really achieve the multiples that a larger company would have. And if you look at it, the biggest one that everybody comes back with is its scale. You just need to be bigger. So if you're a 600,000 EBITDA company, you're just not going to get the multiples. You're just going to sell for 1x. You're going to be kind of stuck in no man's land in this microcap market. Versus if you can get to 6 million, for example, that would dramatically change your expectations. And if you think about it, the simple answer is, well, there's a lot of like operations in the world. So why can't we just put six together as a sell side roll up and sell it? So why wasn't that possible? The only real possibility was a buy side roll up, which really didn't benefit the seller any, because in a buy side roll up, someone's buying each individual company at that 1x multiple. So why can't we flip the script? So why can't six like companies come together? And there were four big reasons why. And of the four, only one is actually really true. The first one is you have to have the same financial operational reporting standards. In other words, when you sell a company, if you're 10 like companies, you have to have your chart of accounts, your financials, your KPIs, your metrics, all reporting as if you were one company. And so typically in the past, that was required is everybody would have to change to the same software system, do all that integration, which is very time consuming, very expensive, very difficult. And that was one of the biggest barriers. Now, fortunately, with the onset of AI, one of the best tools that AI has ever done is it can do all of that analysis very, very quickly. So now with AI, you can take 10 companies on 10 different accounting systems, and in a matter of hours, AI can bring it all together, put it together as if you're one consolidated company reporting off the same ERP system, and report it to financials. So that is true. You have to have that for due diligence. Now with AI, that kind of takes that off the table. So then you get to the other three big biases that are out there as to why companies, like these sell side companies, can't just come together quickly and sell. And the first is that you had to merge. There was this belief you had to be one entity structure. And I was actually on a phone call yesterday where that belief was raised. You need to all merge and come together as one. That's not actually true. You can be separate reporting entities all the way up until the time that you sell. So you can operate collectively and sell separately without any issue. And if you flip to the buy side, this is not an uncommon situation. In real estate, for example, if you buy a real estate portfolio, every single property is its own LLC. So every single property is its own entity. So the ability and the knowledge and the legal firepower to be able to buy a bunch of entities at the same time has been known. So that was the second bias. The third bias is related to the second bias, which is, well, if you merge, you have to all agree on who's the leader. Well, no, you don't all have to agree on who the leader, and that's very difficult. Independent, strong, opinionated, very successful entrepreneurs trying to put 12 of them together and agree who's in charge is going to be a breakdown. However, with this way, since you don't have to form and merge in an entity, you can continue to operate separately. And oftentimes, when you think about what's the difference between the post and the pre-sale is, well, most entities, most companies, small companies that come together, they're either geographically locked, meaning they've got a certain region and there's very little overlap, or you're customer locked. You have a distinct set of customers and you don't have that much competition. So from the buy side, that's what they're looking for. They're looking for a geographic land and expand, or they're looking for a customer land and expand. So that fits perfectly for them. And then the last bias that really came about the whole thing is everybody has to exit at the same time, meaning that everybody has to leave their business at the same time, which is also not true. Now, the companies all transact legally at the same time, but each business has its own employee agreement. So let's take medical practices, for example. If there's 12 medical practices, each doctor can agree to say, I'm going to stay 3 years with 2 years of runoff. I'm going to stay 5 years. I'm going to stay, so each person can dictate or is in control of how and when they want to leave. So that's really what's preventing these like companies to come together and sell as a collective or sell as a portfolio. The biggest barrier, which was the merger of the books, well, that's been taken care of with AI, and the rest of it is just bias from how it's always been done.
Yeah. Any other thoughts on that, team?
Yeah, I'll add to that a little bit. I'll agree with Will on that. And having come from the buy side, and been part of two companies doing the roll-ups, when you're looking at the size of a company, and it really relates to the value, right? So if you're looking at a smaller company and you want to acquire that and then 10x it, that might take a lot of work. You still have to do the same work, and as it goes to cleaning up those messy books, the employment agreements, all the due diligence, all those items still need to be collected and reviewed by the internal team. And if, quite honestly, if the business is smaller, that's a lot of work versus if you buy the company that is 10x to begin with, and then you grow that company, you're much farther ahead. So I think from a buyer's perspective, it comes down to really, bandwidth and capacity, right? Everyone only has their own certain amount of time and team and bandwidth. And really, are you going to work on looking at 10 smaller companies and fixing them up, fixing them and rolling them in and growing them, or 10 bigger companies that you're going to do the same thing with. I think what Will talks about is really this kind of magic between doing some of this work on the front end with sellers and bolting them together on the front end so that they appear as one big company, and you've already collectively cleaned them up and you've already worked out all the bugs and fixed all the holes and all that kind of stuff on the front end. So they're presented as a big company and treated as a grown-up company, a bigger company, and therefore they can then command the values. So I think there's really this new paradigm and revolutionary way of thinking about this microcap market, and how do we really bridge that gap between the sellers that we know need to exit and create a transition and leave a legacy for their own family, but also bridge that gap to the buyers. And really what we've seen in, the private equity market, the financial market, where deals have started to slow and, there's been some overfishing of the market and so forth, and even family offices. So providing different opportunities for them as well. And I think, these ideas that we're talking about is really figuring that out is really exciting for everyone. The buyers, the sellers, those of us involved. I think it's really exciting.
Very cool. So, it kind of sounds like, we're hearing that it's not about company quality, but it's really the marketplace is wired to look at a company in a very specific way. You mentioned scale and growth as being structures that are important, not only for valuation, but whether the company can even get a serious buyer's attention. Bob, maybe you can expand or shed a little more light on, how does scale influence buyer optionality and capital efficiency, but also, if multiple companies can be presented as a portfolio, how does that change perception?
Yeah, sure thing, Will. And I completely agree with Angela. I was going to make a fly fishing analogy. You can pitch a trout perfectly on it, but the trout knows how many calories it's going to expend going over to get that fly and whether it's worth it to do it. And I would extend that to private equity on it, not only on the capacity on the front end, how many deals can they do, how many can they effectively manage, the amount of work required to actually scale up a business to the next tier, which of course is what private equity is focused upon, right? There's going to be a realization event on that horizon, ideally within 3 to 5 years. That's the expectation. So it's a heavy lift in a short period of time. But there's also a constraint on the other end of it, which, most private equity firms are investing through a pool of capital that has been raised and needs to be put out the door, and trying to look at smaller opportunities on it doesn't necessarily get that capital out the door as quickly as it needs to be. It's perhaps unfortunate, but it's a reality within it. You have 10 years to fully invest and exit most of the limited partnerships private equity raises. That gives 3 years generally for investments on the front end, and then a holding period of 3 in the middle, and then 3 to 4 exiting on the other end. It obviously runs sequential when they happen, but that's basically the way it works. So the time's ticking on that. So that's one facet of why these companies have been ignored to a degree. Anecdotally, our traditional cutoff line for enterprise value was 10 million for what GF data tracks. And I think that tells you a lot about the market. Those opportunities below were not really considered fit for private equity or worth the amount of work on it. But if you look at what we've seen over the last 2 years, particularly, a whole lot of consolidation going on with private equity firms trying to build up portfolio companies. And for some of the exact same reasons that the syndicate model actually addresses at a smaller scale, right? Trying to build up geographic presence, trying to build up a presence within a particular specialty area, whether that's healthcare, pet care, et cetera, on it, home maintenance, et cetera. But this is already within private equity's playbook. It's just that the opportunities have been too small before on it. And I think that's what the syndicate really addresses on it, getting it above that threshold where you're going to have private equity attention, which then means you're going to get a competitive bidding process. In most cases, you're going to get multiple arbitrage based on the size going up. You're going to really enter those tiers of the mid-market where you've kind of been isolated out just by size before. We're talking specifically, 500 million EBITDA is not going to make a viable candidate equity firms. It's too small to scale. Generally also at that size, you're doing a lot of work to scale it. You're doing all these acquisitions. You get that up to 2 to 3 million, it starts to become a lot more interesting. Above 5 million, it becomes very interesting on it. But I think it's a nice synergy between kind of current market consolidation and then taking the companies that were too far below the kind of threshold or bar in terms of enterprise value for private equity and getting them up above it. And also doing some of the work, and I think as Will attested to before, getting some of that value that comes from the multiple arbitrage back to the sellers on it, who would normally have to go off at a 1 by 1 at a 1x or 1.5x valuation, which it's not nearly as nice as a 4.5 or 5 times once you build it up into through the syndicate.
Yeah, I think that's a great point, Bob. Any other comments or thoughts on that, Will or Angela or Andrea?
I would say the only thing I would touch on is that is the feasibility, because I think a lot of it is in the past this wasn't feasible, but now it is feasible. So it's always been talked about as kind of like this could be done. Now it can be done. I think that's really where we're seeing the shift is it can be done. And so now the exciting part is these smaller companies, as they come together, create a new source of deal flow. Back to Bob's point, they're creating these companies that almost like synthesizing these new opportunities for a bunch of investors that have a lot of capital that they need to deploy. So it's a win-win on both sides. So it's a really nice situation where all parties are benefiting from what is now feasible.
And Will, you're getting a leg up on the consolidation side of it also, right? I don't think most of the companies going through or the syndicates going through are going, once acquired, they're going to continue to make acquisitions on it. You already have the base of that network set up from the syndicate. You obviously have contacts beyond the syndicate on it. But I think from a private equity firm standpoint, you've already started that consolidation. You've already started to do some of the legwork on it within this particular area. And quite possibly on the, producing new opportunity side, you quite possibly hit upon an area that was ripe for consolidation, but hadn't been addressed yet because those companies were just a bit too small for private equity to notice them.
I want to add to that a little bit also, Bob. I think you make a great point, and when you discuss the timeline with private equity, right, in terms of making the investment, growing the company, holding it, exiting it, we all know that the clock is ticking and it ticks fast. So the more we can do on the front end to, consolidate these businesses, to make them whole, to really streamline them, make them more efficient, the better a product that the actual buyer is getting, right? They can begin layering in their efficiencies, their team, their process, and so forth much faster once the deal is closed, and they can go farther faster in that predictable time range that we know that they need in order to exit. So I think that's a huge value to the buyer as well.
Very cool. So obviously touched on scale, that investors are reacting to not only financials, but they're reacting how the opportunity feels or is presented. Andrea, I'm curious, how you see that play out when companies move forward together, but also how leadership and performance determine what happens once they're there. So, when companies align around those performance expectations, what changes could investors look at to help enhance leadership or drive that opportunity?
Yeah, great question. Thanks, Will. So when companies truly align around shared performance expectations, what changes really isn't just internal execution, it's how predictable the business feels from the outside. So investors start to experience the opportunity as lower risk and more repeatable, because then decision making is more consistent, priorities are clearer, and the leadership team is operating from the same definition of success. So what we often see is that misalignment doesn't show up in the numbers immediately. It shows up in how decisions are made, and investors pick up on that quickly. So when that alignment is real, the business feels cohesive and scalable, not personality dependent.
Okay. Yeah, that's some really great feedback. Other thoughts?
Yeah, to touch on that, I think this touches on what Angela and Bob was saying, is that with the syndicate model, which is basically allowing like companies to operate separately but then sell collectively that are typically too small, because of the way the model works, you're doing pre-due diligence work ahead of time before it's going to market. So that window creates the opportunity to tap into exactly what Drea was saying, which is how do you start to demonstrate and how do you start to get predictive results or get predictive outcomes from the leaders that are currently there. So being able to demonstrate that, get back to Angela's point of, holes, being able to demonstrate that all of these people are working together, you can actually get to a point where a syndicate is outperforming a company that already exists under a single entity, like multiple locations under a single entity. You can actually get to a point where a syndicate is outperforming at that level, which, back to Bob's point, when it rolls right into the private equities portfolio company base, now a lot of that work's been done, so that they're accelerating their ability to get to that next level and integrate them more efficiently, and then be able to either shorten the whole period or achieve the whole period, because right now whole periods are being kicked out or extended as they're trying to figure it out. So at least you're just being able to be more efficient and more precise in your execution.
Yeah. So I have a follow-up question. Either Drea or for the whole group can kind of think about this, but what makes some founder groups capable of working within a syndicate while others potentially may struggle?
Yeah, happy to start us there. What we've seen is really the difference isn't actually about the syndicate structure itself. It's about the leadership team's ability to operate independently under this group of multiple stakeholders. So the groups that work well in a syndicate environment tend to have clear decision rights, strong internal alignment, and low ego around input. They can absorb perspectives without them losing direction. And the ones that struggle more haven't really fully aligned internally first. So additional voices just amplify existing ambiguity or tension there. One dynamic we've seen quite a bit in this setting is that some founders go into a syndicate thinking that the structure is as if it's kind of a typical just acquisition and merger of businesses, thinking they'll be collaborating or even influencing other businesses within the group, when in reality, each of these companies is still operating separately. So understanding that the primary benefit of this process is typically valuation, not necessarily operational leverage across the group, is really important. And the founders who recognize that upfront tend to navigate the structure much more just efficiently, so that syndicates don't create more problems. They actually expose where the leadership is actually already operating as a system within these groups.
Right. Yeah, I saw heads nodding. So thoughts, Angela, Will, or Bob?
I think the one thing. Oh, go ahead, Angela.
No, I just said I don't have anything to add. I think that was great. I mean, she's spot on it, right? That's one of the benefits and I say magic of the syndicate is that they can continue to operate independently. And Will referenced it earlier, but we've all seen it, the idea of who's the leader, right? When you start to aggregate businesses and pull them together, they don't get to be successful businesses without healthy egos. And then when you get them all in the same room, there's a lot of decisions to be made, and there's a lot of potential things that come up that need to be decided. And rather than trying to herd cats and decide who's really in charge, I mean, I just really think that's one of the beauties, is that they all can continue operating independently until the exit with a collective agenda of increasing valuation. I mean, that is it. That's everybody keeping their eye on the prize, right? And that's it. But you get to get there your own way. And I think that's really powerful and unique.
Yeah, and to touch on that, I think one of the things that, just to give like an example, if you had a single business that's, doing $500,000 in EBITDA, to say, I got to grow to 3 million in EBITDA, how many years is that? And then if you go down the acquisition channel and you're buying one at a time, like how many years does it take to find one, integrate it, find another one and integrate it? I mean, it's people quote 3 to 5 year horizons. With the syndicate model, you can bring 10 like operations and go from 500,000 to 5 million in a matter of a quarter, 6 months. And now you're ideally positioned for an exit. So in essence, from an individual's perspective, you're moving, to Bob's point, of 1 to 1.5 in EBITDA. So if that's $500,000, you're looking 500,000 to 750,000. And 6 months later, now your likely return is 4 to 5 times more. So now it's 2 million to 2.5 million, and that's done in 6 months. That's really the secret sauce on all of this. and you're still ideally positioned to make a great acquisition target and a great part of a private equity firm because you're a new source of deal flow that literally doesn't exist outside of this collective syndicate model.
Yeah, I'd like to add a little bit to that as well. I mean, again, having been on the buy side, the syndicate model is it's such a great reinvention of the way that you're looking at M&A. One of the companies I worked for, we opened a market with 14 units, and there were two that were the same owner. So when you're essentially working with 12, 13 different owners through a diligence process, and then once the deal is done, through an integration process, I can speak very clearly on that being incredibly difficult. Even when it's in the same market, even when it's in the same industry, even when they're in the same, even similar revenue and EBITDA ranges. I mean, everyone is, it just goes back to when it comes to the people, right? I mean, these businesses don't run without people. And it's such an enormous amount of change for people, especially in small businesses. So the integration piece becomes incredibly difficult. And what that does is it delays the revenue growth and the profit growth in these immediate transactions. So what we would often see is we would even see a dip, right? So we would acquire, for example, we acquired 14 in this region. We saw dips immediately for the first 3 to 4 months in every single business. And as a buyer, I mean, that's incredibly stressful because, again, the clock is ticking, it's ticking fast, and you're just trying to get your hands around it. So I think the beauty, again, because I love the syndicate model, I think another advantage and beauty of the syndicate model is working with these sellers on the front end and really taking them through and educating them on the front end all these different pieces, what to expect, how to think about the value behind their business, how to put in those standard operating procedures that they, processes that they don't have maybe already, or, as Andrea was saying, address the human capital piece of it, the leadership piece of it, right? All those things we know that they're going to go through in diligence, right? Once they're in that process, we're taking them and putting them on the sell side and educating the sellers ahead of time, which really gives them more leverage and more empowerment and understanding of their own business. So, when you think about the difference is a lot of sellers, especially small business owners, go into a process where they've had an introduction to a buyer and they're excited and, they think their business is worth, so much money and so forth. And then they start to go through the diligence process and they just get discounted after discount after discount. It's pretty deflating as an owner, and as a seller, but they're already too far in to this process and they've been paying their advisors and they're even emotionally attached to an exit or a transition that, oftentimes you see sellers just continue to go through with it and end up unhappy after the transaction or after the effect. They just weren't aware. They just weren't prepared enough. So I think there's just so much advantage to this model all the way around. And really fixing a lot of things for buyers and sellers on both sides of the deal, honestly.
Yeah, I think you really hit that on the head, Angela, because it's the reality that you obviously are challenged with every day of, advisors stuck between the founder expectations and market reality. So you highlighted a few things that are a disconnect, but is there anything that you could highlight that's even more of a disconnect as owners go through this process, or things that you've just discovered they're not aware of that the syndicate either fixes or kind of helps align better?
Yeah, I think, first and foremost, these small business owners just are not at all aware of the process. They have their head down in their business, growing their business, trying to scale it, keep the wheels on, right? They're thinking about employees and training and taxes and the clients or patients they're serving. I mean, it's really a lot. And I think it's unfair for a lot of them because most of them can't afford a business advisor or someone else to help them. So they have a lot on their plate. And I think the first and foremost, they're not even aware of the process, right? They don't even know what's coming, essentially. Even if they work with a broker, right? I mean, a broker is just going to take the information that they already have and then package it up and put it on their site or put it on the shelf, so to say, for sale. They're not an actual broker isn't going to help a business owner fix any cracks or holes in the wall or patch up anything in their business. That's not their job, right? Their job is just simply take what's there and then get it sold. I think where business owners, where there's a disconnect, is they really, there's this idea that I've spent my whole life building this business, right? I've spent 20 or 30 years building this business, and I've made a lot of sacrifices. I've not gone on family vacations, or we've taken out a home equity loan in our house to cover something in the business. There's been a lot of sacrifices along the way. And I think, business owners feel entitled to this entitlement of getting value out of what they've spent their whole life building. And I just think there's a disconnect because they don't realize that even though they've done a great job, a phenomenal job of building a great job for themselves, of likely employing other people in their company, of contributing to the community and their clients or patients or so forth, they really haven't built anything that is predictable or scalable or transferable. They haven't de-risked the business by taking themselves out of the picture from the day to day, right? There's a lot of things they haven't done that make a business more stable and healthier and more transferable to the next owner. So I think that's really just a huge disconnect. Business isn't like it was 30, 40, 50 years ago, where, you had the Ace Hardware in town that was just sold to someone else, right? In town, with technology, with the internet, with AI, I mean, business is very different now. And I think that can be where some of that disconnect comes in.
Excellent. Any other thoughts along that line? Otherwise, I've got a couple open questions for the panel. Perfect. So, we've kind of looked at market structure, leadership alignment, execution readiness, advantage of the syndicate. So just zooming out for a moment, looking ahead maybe over the next 5, even 10 years, do you believe the idea that companies are too small to sell will still exist? Or are we entering a period of structural innovation that fundamentally might change exit opportunity?
I think, I think we're going to continue to see innovation at this part of the market on it, if for no other reason. And you look at the middle market. Why is it called the middle market? Well, and why was the middle market? Why is it a thing, right? Like, well, the mega market and publicly traded and everything became overly competitive, overly picked over, too large. And someone had the bright idea of, well, how many businesses are there within the middle market there? Now it's been focused on, like I said, that kind of 10 million enterprise value line and don't go below it. But I see that smaller part of the market being kind of the new middle market on it, as the middle markets become more like the bulge markets and become more competitive and more shopped over on it. So, and then also the consolidation going on. A lot of those companies that were middle market companies are now upper middle market or larger companies. They've been acquired by a strategic, they've been bought up on it. So I really see this as the potential, or one of the potential new supplies for companies out there, because it gets exponentially greater in terms of volume with the number of businesses out there as you go down in size on it, right? But there's been governors on being able to access those businesses at the largest spot, which is the very smallest ones. And the syndicate model starts to remove some of those governors. And if you consolidate those businesses, obviously there are fewer of them because they're consolidated, but it's still a huge supply of very vibrant, very solid companies that were just too small to be considered before. But I think, this becomes, and as Will said, a new source of deal opportunities for private equity and strategic buyers and others on it, because they're actually of a size that will attract attention and can get scale and still fulfill some of those core, priorities for private equity of, regional growth, regional footprint, or footprint within a particular discipline, or that sort of thing. So I foresee it increasing as time goes on, and probably more rapidly in the next few years.
Yeah, I would agree to that. And just to give size to it, I mean, depending upon which metrics you use, there's 10 to 20 million companies that fit this lower, this micro cap market that, are in this 250 to, 750 million in EBITDA that, have historically been overlooked to the point where 80% of them that try to sell can't. So with the syndicate model where they can come together, all of a sudden that opportunity becomes large. And now once you have kind of an untapped open, if you think about an ocean, like there's a whole pool or another sea or another area of new opportunities. I think that's where, the competitive pressures will push people, or people are going to look to find new ways to get into it. So just the size of it, I think, is going to make that an opportunity for everyone.
Very good. Good insights. So this is for everyone as well. So if you were advising a founder or advisor working with a founder today who wants to increase the exit opportunities within the next 12 to 24 months, what's the single most important thing they should do, or next step they should take?
Yeah, happy to jump in here. The single most important shift, I'd say, from moving a founder from a founder-driven business is taking that and actually creating a leadership system that can operate independently. So most founders really start by thinking that they need to grow more or improve their margins, and those things matter. But what actually expands those exit opportunities is proving that the system and the business that they've built can perform without them. As you heard Angela saying over and over again, has to be transferable. And that really means clarity around decision making, visible leadership accountability, and just overall evidence that the team can execute consistently. Ultimately, buyers aren't just buying the business as it exists today, they're buying confidence in what happens after the founder steps back. And that's a piece that so many founders forget about.
I would completely agree with Dre on that. And I think with that step, once you're able to have leadership working independently of the founder on it, the founder should step out and look at the business as a buyer would look at the business, not as the person running it for all these years, but where are the weak points? What are the things? I mean, also dedicate some time to thinking strategically about the business. We all get wrapped up in the day to day. We all do the same things by rote day to day. And, yet still the definition of insanity is doing the same thing and expecting different results on it. That's what a owner needs to do at that period of time. Take the rose colored glasses off, acknowledge and pat yourself in the back for building something amazing and spending the sacrifices you made, but then stand up, look at it objectively and say, where are the problems here? Where are the challenges? What would someone who was going to run this business without me need to do, need to change, need to improve on it? And that obviously, most important part of any business, most businesses are the people who go home every night, right? And the people who manage it and run it and keep it going and everything. What does that look like? But then also putting in time of what would it take to go to the next level of this? And are you the right person to bring it to that next level? Which I think is an important thing, which Angela alluded to too. We all want to be experts on everything, but the reality is our talents probably lie in a specific period, a specific time, doing a specific thing. Figure out what that was for you or is for you on it and where you can add the value. And I think that should go into your decision when you're looking at a potential realization event as one additional factor.
Yeah, great feedback and thoughts. Well, unfortunately, it looks like we don't have any questions from the audience at present. Any final thoughts or closing remarks before we wrap up today? Excellent. Well, panelists, everyone, thank you for your time. Thanks everyone for joining us. We hope this conversation clarified how a syndicate works, but also the opportunities that may present themselves beyond the small to sell microcap market. This roundtable is part of a series from PL3, where we explore topics like leadership, organizational performance, culture, and investor decisions in greater depth. Next month's topic will be a session focused on AI and technology. We hope you will join us. To learn a little bit more about us, visit pllab.com. We'll see you this next month.